I stumbled across this relatively new Fidelity ETF titled FCPI, the Fidelity Stocks for Inflation ETF. And at a time when inflation is surging to 40-year record highs, needless to say, this caught my attention. I'll give them credit for a creative ticker symbol, FCPI, CPI of course being the Consumer Price Index, a measure of the average change over time and the prices paid by urban consumers for a market basket of consumer goods and services, aka how we measure inflation. This ETF is designed to, quote, reflect the performance of stocks of large and mid-capitalization U.S. companies with attractive valuations, high-quality profiles, and positive momentum signals, emphasizing industries that tend to outperform in inflationary environments. This sounds great, but is FCPI legit, or is it a name gimmick? In this video, we will discuss the type of stocks and sectors that tend to hold up better in inflationary environments. We will analyze the portfolio composition of FCPI to see if it contains what we would expect, and then we'll look at the performance of FCPI to see how it has done so far in the current inflationary environment. At the end, I'll give my own opinion and explain what I'm currently doing with my own money. If at any point you decide you like this video and find it helpful, don't forget to hit the like button, because that's what it's there for. Also, if you want some free stuff, feel free to lurk below and check out the links in the description. You can get free stocks and also a free $30 to sign up with Rakuten, a free site where you can earn cash back on everyday purchases. It's a great way to help out the channel, and with inflation how it is, we could all stand to save a little money. Without further ado, let's get started. So what type of stocks typically hold up best during an inflationary environment? And I do use the phrase hold up best because inflation overall hurts stocks because consumer spending drops. Growth stocks tend to get hit harder than value stocks during inflationary times because they're more reliant on low-cost capital for future business expansion and are therefore more sensitive to the rate hikes that the Federal Reserve uses to combat inflation. Additionally, the bulk of growth stocks' earnings are expected to arrive in the future, which may be worth far less in today's money when inflation increases. This chart helps us understand what sectors typically do best during inflationary times. The x-axis shows the percentage of rolling 12-month periods since 1973 in which equity returns exceeded inflation in high and rising inflation environments. This is essentially a measure of how consistently each sector has beaten inflation in these environments. The y-axis shows the real inflation-adjusted return achieved during those periods, essentially a measure of how much they have beaten inflation by on average in these environments. Energy is the best performing sector in the S&P 500 during periods when inflation rises by 3% or higher. Energy stocks beat inflation over 70% of the time and typically outperform inflation by 10%. The revenues of energy stocks are naturally tied to energy prices, a key component of inflation indices. Additionally, demand for gas and electricity remains relatively the same regardless of the price. They can pass on the increased costs to their consumers, and consumers will pay it because the alternative is freezing, sitting in the dark, or not driving your car anywhere. This is inelastic demand. Equity real estate investment trusts also tend to be a good hedge against inflation. They beat inflation 70% of the time and average a 5% inflation-adjusted return. This is because they own real estate assets and can pass on price increases in rental contracts and in property prices as inflation goes up. However, equity REITs are not to be confused with mortgage REITs. Mortgage REITs provide financing for income-producing real estate by purchasing or originating mortgages in mortgage-backed securities and earning income from the interest on these investments. Just like bonds, their coupon payments generally become less valuable as inflation increases. Commodities such as precious metals are often the go-to during inflationary times. However, the companies in the space post mixed results. Such companies posted an average real return of 8% in high and rising inflation environments. But the likelihood of this happening was very much a toss-up, in that they only beat inflation 47% of the time. It's also worth noting where the IT stocks fall. Tech stocks tend to be growth stocks. As we mentioned earlier, growth stocks are valued based on their promised future growth in profits, so most of their cash flow is expected to arrive in the future, which may be worth far less in today's money when inflation increases. I'll also note that healthcare is very much in the middle of the mix. Healthcare is a necessity. So these companies can pass on the increased costs to their customers without too much issue, so they don't typically underperform during high inflation, but they also don't really outperform. Alright, now let's take a look at the composition of FCPI. What we find is that this ETF is very much a blend of large cap growth and large cap value. Based on what we said about how growth stocks respond to inflation, you would expect that an ETF like this would very much avoid growth stocks and skew much heavier to value stocks. This is not the case. Moving on to sector exposure, there's a reason why I specifically highlighted tech and healthcare on the equity performance during high inflation chart. That's because this ETF is 40% tech and healthcare. Now, healthcare is very much middle of the road when it comes to inflation, but it's very well known that tech tends to underperform during inflationary times. You would not expect tech to be 20% of a stocks for inflation ETF. In fact, based on how much energy tends to outperform, You would expect energy to be like 40% by itself. Instead, we see energy down at just 10%. Now, it's very possible that the managers went through the tech sector and cherry-picked the best tech stocks that hold up during inflation. I don't exactly have the time or expertise to go through all of them, but we can at least look at the top two, this being Apple and Microsoft. They make up 10% of the ETF, but looking at Microsoft first, they don't have much raw costs. It's software. So if gas prices go up, they're not shipping anything, and companies need their software. If prices do go up, so they can just pass it on to their customers. Apple, on the other hand, is selling technology hardware, so they are dealing with materials and shipping of products. Granted, you can fit a lot of phones in a shipping crate. You can fit a lot of phones in a truck. And the Apple customer base is so loyal, it can almost be seen as a necessity as opposed to a discretionary, and thus they can pass on costs to their consumers. But you could also argue that if people are burning all their money on high-priced gas, groceries, and rent, maybe they'll pass on the new iPhone this year. So, although we have only looked at 2 tech stocks in this ETF, you can at least see the argument for including them in this ETF, while tech stocks otherwise tend to do poorly during inflationary times. I'm not going to sit here and say that I'm more intelligent than the people that built the portfolio composition of this ETF, and that they're fools for constructing and how they did. I'm sure they're smart people. I'm sure there's a rationale for everything in this ETF. But you can also see the argument for someone who might just buy an energy ETF, such as FENY, the Fidelity Energy ETF, if they're looking to make this trade. But before we get into that, we should also take a look at the performance of FCPI versus the overall market. Since the money printing began in March of 2020, FCPI is up 85% compared to the broad market return of 70%. If we move over to the 1 year, FCPI is only down 7% compared to the broad market being down almost 20%. So it has held up better, but it hasn't exactly been a home run. If you're looking for a home run, energy is up 50% on the 1 year. This is during a time when the rest of the stock market has been getting absolutely crushed. But keep in mind, here we're just looking at the returns of the current inflationary environment, and that there are a lot of variables that go into whether or not certain stocks go up or down on any given year. Inflation is only one tile in the mosaic of what is really going on. Granted, this year, it's a pretty big tile. Just out of curiosity, I looked at the overlap of FCPI and VTI, the Vanguard Total Market ETF. They overlap 30%. Maybe this is higher than what you would expect, given one is a specialty ETF designed to target stocks that do well during inflation, and the other is not. So what are my thoughts? I see this more as a medium-term trading tool. You think inflation will be high over the next few years, so you buy this ETF and then trade out when you think inflation will be going down. I'm not a trader. I don't like to make moves where I not only have to time the entry point, but also have to time the exit point. It's just too hard. But honestly, if I were going to do that, I would probably just buy an energy ETF. Am I right? 70% of the time, they beat inflation in high inflationary environments. You remember the graph. Nothing else is really close. Granted, every inflationary environment is going to be a little bit different. So you could value the added diversification of owning an ETF like FCPI, but for that, there's also an argument to just buy a value ETF. Value is likely to hold up better than the broad market during inflationary times. And like the energy ETF, a broad market ETF is likely to have a better expense ratio than a specialty ETF like FCPI anyway. Granted, if we're talking about trading as opposed to long-term holding, maybe expense ratio isn't that critical. But as for me, I'd rather just buy the dip in stocks at this point, as opposed to trying to buy something that may hold up better to further losses. There's an argument to be made that by the time soaring inflation hits the news headlines and you're thinking about trading into an inflation ETF or energy ETF, it's already too late. I mean, just look at the graph of the Fidelity Energy ETF. Could it keep going? Sure, but it could also be a top. Every dog has its day, and energy has certainly had its day this year. At this point, I would rather buy the dip in hard-hit stocks that I like for the next 5 to 10 years and just hang on. I don't have a problem buying growth stocks in this environment, even if there's more short-term pain ahead. I'm not in the wealth preservation phase of my life. I'm in the wealth accumulation phase of my life. So you really have to know your situation. It's different for everybody. But sometimes you have to be a contrarian and buy when there's pain in the market. Be greedy when others are fearful. Be fearful when others are greedy. The seeds of wealth are sown in a bear market. But if you found this helpful, consider hitting the like button. Subscribe for more content like this. Again, also consider checking out the links down below. Currently down there, you can get 2 free stocks with Webull, potentially valued up to $2,300, a free stock with Robinhood, and $30 with Rakuten, where you can get cash back on online purchases. However, these promos do change over time. As always, this is not financial or tax advice, just entertainment purposes only. So thanks, and I'll see you in the next video.